tell us a bit more about that timeline here, and what's the probability that this could actually come into fruition?
The timeline, we were seeking to just find a time period that is far enough away that ultimately we can start driving a conversation on what needs to be done to avoid such a timeline, but near enough that would kind of shake people a little bit, and ultimately we do think it's going to take a while for this to diffuse through the entire economy, but it's more a question of what happens at the leading edge. I think especially in the U.S., the job market is just very weak for white collar jobs already. And so the thinking and the ultimate fear is that it's not going to take that much to sort of push things over when we haven't really generated any white collar jobs in the U.S. over the last 3 years, when they take out things like healthcare and education that are primarily driven by government spending. And so that's kind of the underlying thesis here, is that there's going to be significant replacement of jobs with AI, specifically AI agents. Those things only really came into fruition in the last few months. And so as it comes through and shows up in the productivity of different corporations, that's when things are going to get a little more interesting and where we got to pay real attention.
Alap, David here. Were you surprised by the market reaction?
Yeah, I was. I thought there was going to be a small reaction. It was definitely larger than we expected. But I think it's not that surprising when you take a step back and consider kind of where the markets are in the U.S. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. And essentially, like, everyone is max long today. And so there really aren't many incremental buyers left. And so it, on the one hand, spooks people when you do consider what is negative about this. But I think specifically the market right now is trying to digest this idea that AI has gotten a lot more powerful in the last 6 months, and it's going to start changing. It's not just going to accrue to the benefit of every corporation and every foundation lab and every semiconductor company, but instead it's starting to disperse and figure out, hey, who are the winners going to be and who are the losers going to be. And so software is the best example. The markets have been selling software for almost a year now on the AI threat. But they really accelerated in the last few weeks. And this is, the problem with this, if you're long software, is there's nothing to actually disprove the thesis, because the thesis is a few years out. It's not today, but you have not much to stand on, because ultimately that thesis is going to get stronger as AI itself gets stronger. And so we just are entering a really kind of highly volatile time in the markets, because the timelines are short, but things are in fact happening now.
Yeah, I was about to say 2028 is closer than the most recent presidential elections, right? Let alone the pandemic, which in my mind seems still very, very fresh. Alap, I just would have been doing my duty if I didn't ask you this. Were you or anyone at the research firm short these names going into this? Was this a short seller report guised beautifully in the form of a beautiful fiction?
We are constantly sort of, turning our book, and we certainly had shorts in some of these businesses. We generally have a set of shorts out against businesses that we think are going to be disrupted by AI. And on the other side of that, we own a lot of semiconductors that we think are going to benefit. But ultimately, we just wanted to get this story out to the market, because while the risk to individual stocks is certainly meaningful, the main story for us is that the risk to the overall economy and ultimately the consumer economy in a world where, we don't figure out what to do if the jobs start going faster than we think.
And you highlight quite articulately just kind of what sectors might be hit, right? I think food delivery was certainly the one when you mentioned about DoorDash, Uber Eats, and the like. This is really kind of the fee-based business model. You mentioned, of course, software was sort of the opening shot. What other sectors do you think could be the next victims here? I know you lay out a whole list of them, but what are the ones that we really need to focus on? And maybe what are some of the sectors that are best positioned in this whole AI scare trade?
Other sectors that I think we think have real risk are just generally intermediation sectors. And so DoorDash is an intermediary. It runs a marketplace for food, Uber for cars. But I think where the markets are just beginning to sniff things out is most of financial services is ultimately intermediation. Insurance companies are intermediating risk. Banks ultimately, when it comes to their credit card businesses, as well as their lending and sort of deposit businesses, are an intermediary as well. And so the real basis of this thought exercise was just thinking, hey, imagine it's 2 years from today, and most of the things that you do on your phone instead now your agent does for you. So instead of having to open up the Chase app and go into Zelle and send a payment, you just simply speak to your phone, hey, send a payment to my friend. In that world, you are a lot less tied to the UI of the Chase app and your bank branch and everything else, instead of just, hey, whatever gets it done most easily and ultimately most cheaply. And so right now, the high-level thesis of all these intermediation businesses for us is that they are generating great returns because the customer wants one relationship, maybe two relationships. They're comfortable with that brand. They're comfortable with the UI. They're comfortable with their locations. And so they just stay with them. But in a world where you have an agent and the agent's job is to just look for better prices for things all day, every day, it's going to do a good job of finding you alternatives where you don't really feel the friction of moving from Chase to Citi because it's doing all the work for you. And similarly, like if you think about in financial advisors, right now it's really hard to move your money from one financial advisor to even an ETF, right? You've got to open these accounts, you've got to make all these transfers, you got to do all this research. If the AI comes to you and just says, hey, you're spending 1.25% a year with an advisor at Raymond James, and instead you can get essentially the same return minus those fees with this ETF. It will be, for some folks, it might be a lot more compelling to make those changes. And so a big part of the way these businesses have moats and sort of keep their customers every year is that there's just a lot of friction to changing. And that friction really drops precipitously in a world with agentic AI.
Yeah, what stood out to me too is, agentic AI, as you point out, the technology does not consume the same way humans do, right? Discretionary spending, food, travel, whatever. So that massive, capital flows that would usually go into, things that we consume, goes, if you think about it, goes straight into the pockets of the big tech. So I want to differentiate, I guess, the concepts from this being bearish on humanity and bearish perhaps on labor markets, because you do have some big winners that seem to be emerging under your scenarios. And how do you look at the big winners? It might necessarily not be too bad for markets, is what I'm getting at here, Alap.
It's tricky as far as how this goes for markets if this plays out. Clearly, semiconductors are huge winners. Things that are upstream to semiconductors are huge winners. So everything required to construct a data center and ultimately kind of material stocks are huge winners. Clearly, foundation labs are huge winners. And then businesses that have sort of true economic moats are also big winners. So things like, ultimately, things like brands and other status goods that, as long as the consumer continues to spend, will do well. But the flip side is, the real thing to sort of underscore is, if this plays out, and especially if it continues to play out without a policy response, then the thought experiment we use in the first piece is, let's say 5% of white collar workers lose their jobs in 18 months. And there aren't other white collar jobs for them to get because the white collar, just economy is shrinking pretty badly. What are those folks going to do short of any policy response? They're going to have to go into the blue collar markets and the gig markets to try and make ends meet. That is going to massively depress the average price that someone's going to be able to get for working in the blue collar markets or the gig markets. And so it's all one closed system. It starts with white collar, but it is one closed system. And so if we let AI replace the jobs without taxing the AI appropriately, then it can really get to the core of the consumer economy. And that's where some of the real contagion cases can happen. Now, as long as we are clear-eyed about what's happening and then take steps to make sure that, we're not trying to suggest that we should just massively increase the tax on AI companies or semiconductors or anything else, but there are going to be a clear set of winners and a clear set of losers from this scenario playing out, or other scenarios that rhyme with it, which seem very likely in an AI world. And our point here is that, we should be looking hard at figuring out how to tax some of those incremental gains, windfall gains really, and sort of keep our society running and whole. And if we're able to do that, and then, let's say that 5% job loss happens in 18 months, but it only translates to a 1% or 1.5% decrease in consumer spending, then we can kind of work our way through that. But if it translates to a 4 or 5 or 6% decrease in consumer spending, then it's very, very scary.
You mentioned about the need for policy. I just want to kind of mention a little bit more about this negative feedback loop that you're saying that this could have on the economy, right? You're saying AI getting bigger, better, and cheaper. Companies lay off workers. They use the savings to invest more in AI capabilities, lead to more layoffs, displace workers, and then companies that sell things to consumers sold fewer than weakened. And then you have used AI to protect margins. AI got better and cheaper. A feedback loop with no natural break. You mentioned in this report, though, there's still time to direct toward a different future, that we're not quite there. And we can't avoid that sort of extreme scenario right now. I'm just wondering what is going to be what breaks this negative feedback loop?
So the underlying feedback loop is that the smarter the AI gets, the more things it can do, the more jobs it can replace. And that we think of as very secular. It's never going to end. We're just going to continue to be able to improve it. And so the feedback loop needs to be broken from a policy perspective. And so that means that we need to understand kind of where the jobs are going, what's causing the displacement, and then figure out how to tax the incremental gains or the windfall gains from AI. And those will accrue in two places. They'll accrue in the AI complex, so to material stocks, semiconductor stocks, and foundation lab company stocks and some tech stocks. But the other place likely that it will accrue in an even larger form is in companies that are able to cut a lot of jobs but don't have their demand suffer as much, because their margins will also explode. And so in that world, it seems a little asymmetric to have the same corporate tax rate for someone who is selling food as somebody who's selling a semiconductor. When that incremental semiconductor is costing 10 jobs and can really hit the market and the economy. And so I think we need to start thinking a little bit more expansively about how we structure our tax code so that we can maintain the equilibrium. And ultimately, in that world, we think it's very bullish because AI is massively increasing productivity, GDP growth can zoom. We think be in a world where there's a lot of more abundance than there is today in a relatively short order. But if we want to maintain the system as it stands now, rather than tear it up and build a new one, or tear it down and build a new one, then we got to think about sort of tax policy that is targeted specifically at what is driving those job losses.
Are there specific milestones? Okay, let's just say it's a very useful fiction at its worst. Let's call it that. 2028. You mentioned at the top that that's just something that you guys came up with that is not too far but not too near enough. Are there specific milestones? Let's call it over the next 5 years. Even that seems long, but over the next 5 years, specific milestones that you think we should be watching to figure out and course correct, or figure out whether or not we are headed down this specific path?
I think the biggest tell is white collar employment in the U.S. economy. We think it's going to happen the fastest in the U.S. because AI is largely being built there, and it has the most dynamic labor markets, and so it's much easier to fire folks than it is in other parts of the world. And so I think the white collar labor market, and then maybe the sort of eye of the storm is really information workers and their hiring. Based on the work we did, that employment by information category workers is already down almost 8% from a peak in 2023, and so that is particularly scary. Some of that was like COVID excess when they overhired after coming out of the pandemic, but that's down a lot, and that maps to places like big tech where you see round after round after layoff as they're getting more efficient and as they're able to roll out AI to do more things. And so I think the ultimate tell will be the employment that sort of the makers of AI and the sort of most advanced users of AI are putting out. And then I think other folks in that complex. I think the further you go from technology, the slower the diffusion is going to be. But we can clearly see it in technology. It's a pretty scary picture. Yeah. And there's a reason why it's not going to spread elsewhere when we're seeing the capabilities advance so fast.
Alap, this seems like this really is more of a market story rather than maybe a tech story in some ways. I'm just wondering, what we're seeing the market reaction, we're not quite seeing that here in Asia, particularly when it comes to China itself. In fact, some of these pure plays in China are actually outperforming, and it has been a dominant theme here in China. Is there a sense, China's making cheaper AI models. Is there a sense that they can actually in some ways overthrow some of these offerings, the likes of Anthropic and what they're doing now, at least outside the U.S.?
I think there's two really interesting observations with what's going on in China right now. I think clearly these foundation lab companies that have recently listed are really zooming. It's not surprising to me. They're really the only way in the whole world that you can get exposure to foundational lab companies, because none of them are public in the U.S. except unless you want to buy Google, when you're buying a bunch of other things too. And so clearly there isn't that much supply. Everyone in Asia, but I think folks all over the world are rushing to buy these stocks in Hong Kong, and so it's not surprising to me that they are outperforming and other parts of the AI complex are outperforming. The other thing that I find really interesting about China, and maybe that reflects in kind of what you're seeing in a very muted response today, is there might be a good analog here for what happens over the next 2 years in the U.S. to some extent what has happened over the last few years in China, where as technology, not some AI, but other things as well, especially automation, have really rolled through the economy in a big way. Jobs aren't being produced at the same level. The average corporate can do a lot more with less humans, and they're able to ultimately not hire, and it leads to sort of a pretty weak consumer economy that kind of can drag the entire economy down. So I think there is probably some interesting analog there as well, and so I think there's just a lot less expectation sort of embedded in sort of China's growth from a consumer perspective right now, and so thus this, if it gets a little bit worse, shouldn't matter in the same way that there's quite a bit embedded in kind of the U.S.